How are you? How are you? Very well. We are good. Sorry for the few minutes I've lost. I was telling some other group that people talk about the middle class. Which are the other classes? It's the upper and the lower. Upper and the lower. So I normally hear everyone classifying themselves as being in the middle class. I haven't seen somebody who has classified themselves to be in the other two. But what we know is that the people who find themselves in what you just described, the middle class, they're always running around. So I don't know. They're always running around. So it happens. That's way we understand each other. So our last entry was, I think we say that when you come, we talk about the door theory, if I'm not very wrong. Good. The door theory. So we talked about the charts that are used in the. Good morning online. I can see Emmy, Gift, and John. Good morning.
Good morning.
It's a bright Saturday morning. You're joining us from which place, which part of the world? Emmy, you're joining us from? No, it's good to know because of the timing. The time I delivered this class actually from Singapore. And that was the whole. Where did you get Singapore? I didn't know. In 2022. I was in Singapore. And you see, you have Nairobi and Singapore, you have exactly 5 hour difference. So 11:30 at night used to be 5:30. So would actually go around doing whatever we want to do. Then that late into the night, then we settle. So around 11:40 in the night there, comes 5:40 here, we settle everything. I've also delivered it from London, 2 hours difference. I've also done it from Kampala here, same timeline. I've also done it from Addis Ababa, same timeline. So the middle class, you guys are always running. So I don't. So you, I think you're in the upper. Are you in the upper? I think so. No, actually, actually, let me tell you, it's not. Let me tell you, I normally say that we may differ in opinion. For example, I think we go to think, but now when we have intellectual honesty, then we cite sources. Then now we agree, isn't it? Yes. So, like for example, somebody who says Rwanda is progressing so well, you have the risk of Rwanda overtaking a country like Kenya, for example. I tell them, of course, that's your opinion. Let's just throw only one or two numbers. The argument just changes. You know, in Kenya, how many constituencies do we have? What? Constituencies. 290. So in Kenya, we have 290 constituencies. And out of the 290, I think I heard about one called Northbound. Yes. Northbound. In Marsabit County. It measures 96,000 square kilometers. Square kilometers. Rwanda measures 28,000 square kilometers. So these are country and these are constituencies in a country. So then you start now asking yourself the whole talk about the progress, the all the accolades that have been painted for Rwanda, they start fading. So in the same way you're saying somebody could be in the upper, could be, it's going to throw them. So the middle class are characterized by one, they work for money. So do I work for money? If the answer is yes, even you work for money, you're in the middle class. You work for money. Because the upper class, they don't work for money. The money works for them. The money works for them. Because what happens is that middle class is anyone who is in employment. Anyone in employment is in the middle class. And something that I also learned in 2019, very late in my life, In fact, I didn't know, imagine. The family called self-employment, then you have the other employment without any qualification is here, without any qualifier. Self-employment and employment are exactly the same. There's no difference. Have you also discovered that? Or have you been taught that? Self-employment and employment are the same thing. Completely the same thing. So that now the two of them, self-employment, now unemployment, sit on one side of the drive, then the other side we have entrepreneurs. Yes, a self-employed person is miles away from becoming an entrepreneur. Actually, they don't have any similarity. There's no similarity between a self-employed person and an entrepreneur. If you qualify from a Russian university as as a good doctor, and I give that example because I have a friend who who has that kind of a thing in Kakamega. It's called Nala Community Hospital. So then you come and set up a hospital. So you are the best, you are the one who treats people. You are in self-employment. You are not an entrepreneur. You are not. If not, the queue has to be very long waiting for you to treat people because you are a specialist. You are in self-employment. But now, when this hospital will grow, not even in numbers or wherever, even in that state, even if you reduce the space, but now you have now others who treat people, so that when you are in your farm in Sokimau, treatment is still ongoing. You are now an entrepreneur. That's the difference. So anyone who works, anyone who is in self-employment, working for money, or in employment working for money, like the way I'm doing now, I'm working for money now. I'm in the middle class. So I think all of you are in the middle class. I think if you use numbers like that, then we will not really differ so much because we will not argue so much.
What defines the lower class?
Yes, what defines the lower class? The lower class pay only indirect taxes. They don't pay any direct taxes. They the lower class. So anyone who pays only indirect taxes, consumption taxes, is clearly in there. Yeah. There's no investment taxes they pay. There's no earnings taxes they pay, like the way you pay on your payslip. But they pay when they go to fuel their car, if they have 16%, they know it's been 8, so they pay. Despite kama kwaje ako in the lower class. Anyone who pays only indirect taxes. So the question would be, who are those and where are they? So at least now, because you see, sometimes we may think the lower class are the people in the slums. So the door theory, and even before maybe we talk about the door theory, we normally hear about so that it's not a very strange idea. We normally hear about the indices that we have in the market index here. So like here we have the three of them. We have the Nairobi Securities Exchange or share index. We have the Nairobi Securities Exchange 25. Then we have the 20. Then the 20 that was the longest ever here. In New York, then we also have three. So we have the Dow Industrials Average, which came from this person. Then we also have S&P 500. The other one is the Nasdaq. Here. So I normally tell my students to, because I know you're in the middle class. You guys are, you have you have pay TV. You have pay TV. So CNN, Al Jazeera. Of course, the market section is not so much. It's not so much watched. But then when somebody now gets to this side, then you become friends with people like Todd Benjamin. When they're talking about markets, so you hear what are they talking about. So when you hear, so today in the evening, for example, when you hear the Dow Industrials, yeah, went up 50 basis points, you know we are talking about that. So it is states that security prices don't follow a random walk, but follow some cycles. So that's what we say. There are three trends. Trend kama hii. Trend. Hii tunasema something is trending. There are three trends. There are three trends. That is primary trend. Primary trend. Then we have the secondary. We have the primary trend, secondary trend. Number three are minor reactions. So a trend can also be called a reaction or a movement. So you can say secondary trend or secondary reaction or secondary movement. This can be primary trend, primary reaction, primary. This can be minor trend, minor reaction, or minor movement. It means the same thing. So let me talk about the primary trend. What is the primary trend? Primary trend. It's the long-term trend. It's the long-term trend that takes the entire market. Underline the one entire market. Yote kabisa. Entire market. All the counters that are listed at the boss, zote ziko hapo. Long-term trend that takes the entire market up or down. Up or down for a period of about 18 months. For a period of about 18 months or more. For a period of about 18 months or more. Or more. Secondary reactions or secondary trend, if you will, or secondary movement, whichever you choose, they correct the deviations from the primary trend. They correct deviations from the primary trend. And they last for a few weeks. And they last for a few weeks. They last for a few weeks. Minor movements are short-term, lasting hours. Minor movements are short-term, lasting hours or a few days. Lasting hours or a few days. Or a few days. So we use a chart here to show that. So we normally have the price on the vertical axis. That's the price. It's normally shillings. So this is time, and you can popularly show it in days. So the primary trend is this one. Is the primary trend, right? And you can see we normally show it as either generally up and be down, but it's the general then movement. Then from there we can have now the secondary movement, and they are like this, like that. And these are secondary trend. Secondary trend. So down here, you can have a line like down here, for example. If it touches this point here, for example, down here is a place where the market so this will be the support level, and this will be the resistance level. You see, it's trying to, the market moves up and down, but it oscillates within some range. So the lowest prices are expected to fall at the support level, and the highest, the prices are expected to rise are not breached. They are not expected to breach. That ceiling is the resistance level. So we explain support level, This is the Dow theory of markets. Support level. This one. So the floor down. And you can say a price level below which it's a support, no, a price level. It's a price level below which it's highly unlikely. A price level below which it's highly unlikely for a stock or stock index to fall. So it's a price level below which it's highly unlikely for a stock or stock index to fall. So it's not expected to fall below this level. It's not expected to fall below that. Number two, resistance level. Resistance level. A price level above which it's supposedly, because these are thoughts, it's not a must. It's supposedly a price level above which it's supposedly unlikely for a stock or stock index to rise. So we've explained now those two. So I want us now to have other terms. So we have explained support level and resistance level. So I'll say repeat for the resistance level, please. A price level above which it's supposedly unlikely for a stock or stock index to rise. So we don't expect that price to. So that's why in the business news you'll hear the newscaster says that we expect that counter to be trading 28.30 range bound. Range bound means 28 is the support, that is the resistance level, and the space there we normally call it the range. So will be range bound. So that's the market sentiment. We believe that it won't breach the resistance level being a cap, it won't breach the support level being a floor. And there are some rules in the market when an index, for example, comes to this level, there's a level, and we are going to talk about that, where suspension of trading then happens. If a stock itself individually or an entire index then falls to avoid paper loss for the investors. So other terms, the first one is reversal day. Reversal day. So the first one is reversal day, and we say a stock or market index experiencing a substantial change in direction. So reversal day is a stock or market index experiencing a substantial change in direction, either upward or downward. It would be seen to be a reversal day. So a stock or market index experiencing a substantial change in direction, either upward or downward. So for example, you can say, in our illustration here, you can see that the general trend, which is the primary trend, is generally upwards. Now, if this index, if it's for an index or an individual stock, if it came this way, this will be at the reversal day here. This it would be saying it's a reversal day. It would be saying it's a reversal day. Number two, other term, contrary opinion rule. Contrary opinion rule. Contrary opinion rule in the market. What is contrary opinion? That means the opposite opinion. When the result of technical analysis, when the result of TA support a certain decision, when the results of TA support a certain decision, e.g. sell, so when the results of TA support a certain decision, e.g. sell, the investor does the opposite. The investor does the opposite, e.g. buy. So psychological factors are at play. Psychological factors are at play. So that's called the contrary opinion rule. That means when the results of the TA support a certain decision, e.g. sell, the investor does the opposite, e.g. buy. And you say psychological factors are at play. So this is when you come and do your regression analysis, you regress price against time in terms of dates. And when you forecast, for example, like for the coming few weeks, because we say TA is for the short term, the support may be an increase in prices. So you're told the prices are likely to go up. So you better buy, isn't it? But then the investor now says, I better exit my position. So you see, you go against what the results are saying. So it's called a contrary opinion rule. Follow the smart money rule. Follow the smart money. Follow the smart money. This is a rule. It's called follow the smart money. So the first one we've talked about is contrary opinion. It's a rule. We have another rule called follow the smart money. Follow the smart money is a rule. Follow the smart money rule. You say also called smart money concept, SMC. Also called smart money concept. Smart money concept, SMC. It's also called smart money concept, SMC. And you say the investor or analyst